Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house and getting pre-approved and you're wondering, how do interest rates work and what is my actual interest rate that I qualify for? Stick around. In this video, I'm going to teach you everything you need to know about mortgage interest rates. So listen, buying a house and getting pre-approved is one of the biggest steps and moves you'll make in your entire lifetime. But one of the key components around a pre-approval are the interest rates. And there is a lot of noise out there about interest rates, what people qualify for, how they work, how long they're good for, should I lock, should I not lock, should I pay points, should I not pay points? There are all these things. So what I'm gonna do is I'm gonna unpack a couple things with you guys to explain to you exactly how interest rates work with mortgage loans, with consumers, with mortgage companies, and so that way you guys can get some clarity around it. Let me start easy in this area. Mortgage rates are market rate driven. Think about it like a stock, okay? If hypothetically Amazon has a stock price of $99, Amazon's stock price is not going to be the same on Monday as it is on Friday, as it is a week from now, as it is a month from now. It might be similar, but it could go up, it could go down, it's tied to the market. The same thing happens with interest rates. So while they don't fluctuate a ton, now they have over the past couple of years as far as like highs and lows from 2.99 to 8.5, in a normal market, they don't fluctuate that much. They might move 1/4%, maybe 0.5% in a month to 2 months if there's a lot of market activity, but for the most part, interest rates stay pretty steady. They do change from day to day every now and then, but those day-to-day changes are really driven around monthly economic data. So CPI, jobs reports, big data-driven conversations and points in the calendar will move the needle one way or the other. Unemployment, jobs, all these things, you can see more mortgage rates jump day to day. But normally, they're pretty steady. They don't bounce too much, and obviously if they do one way or the other, most of the time a good mortgage advisor will give you a heads up on the direction that it's heading. So if you're in a position to where you have to make a call or lock, they'll help you. If you're pre-approved, obviously there's nothing you can do because you can't really lock until you get under contract, but at least you won't be in the dark about what's going on in the activity. So that's first things first, it's tied to the market. Second most important thing, it is tied to the loan program and product, like a 30-year conventional versus a 15-year versus a 20 versus a 25. The term has a lot to do with the pricing. The product and program, like a 30-year FHA loan versus a 30-year conventional versus a 30-year VA, those are all different as well. They're not just 30 years, they're different type of programs and products. I think the third and the most important thing is really specific to the buyer financial profile and the property profile. So let me explain, then we're gonna go into the last at the end of the video of like, how do all these things work with different interest rates, discount points, who's making money, who should I trust, all these things. But the third point is about the person. So you have on mortgages really like a little grid, okay? It's an easy way to think about it. It's called like a risk-based adjustment. In our world, we call it a loan level price adjustment, but just think about it as a risk-based adjustment. And so the way to frame this and think about it as a person that doesn't live in the mortgage world is we all have a set of friends. We have friends that we could loan $10 to, and they'd say, of course, I'll pay you back tomorrow. And sure enough, tomorrow, they pay us back that 10 bucks. And then we have the friend that says, I'll pay you back tomorrow, but it takes that friend a week to actually pay you back, but they pay you back. And then you got the friend that takes a month, and then you got a friend that takes a year, and then you got the friend that never pays you back. Now we all got those friends, including me, and I've been on the good side and the bad side of both of those payment agreements. So when you look at that bubble of friends and that behavior as an analogy, you would know which one of your friends is the riskiest friend to loan money to. So risk-based adjustments to mortgage companies and banks look at the person and the profile and the property, which I'll talk about here in a minute, as a risk chart, okay? And they're gonna pay attention to a couple of things that I want you to be aware of outside of the program and the product and the market. But when it comes to you and your property, they're gonna look at down payment, okay? Down payment is one of the things that affects interest rates. So 5% down, 10% down, 15% down, 20, and everything on my side in the mortgage industry is all graded in 5% increments. So like 5% down and 9.99% down, it's the same grade. You gotta get to 10. And then of course 9.99 and 10, they're very small, but they're different because they're in different tiers, okay? So down payment is 1. Credit score is 2. Credit scores range in my business for the most part from like 600 to like 740 or 760, kind of as the high and low. And then they grade Credit score adjustments a lot of times in 20-point increments. So 760, 740, 720, 700, 680, 660, 640, 620, and so on. And you can still get a loan, but the best rate is up here, and then this person gets an extra quarter and eighth, and this person gets an extra quarter. So the top FICO score at 740, 760 might get, for an example, 699, and the person at the very bottom can get the same home loan, but they might be 8.5 because of all these risk-based adjustments and add-ons. So down payment, credit score. Third one, property type. So you have to get into the property, because you got to remember, when mortgage companies are making loans to a person, they're loaning to the person, but they're also loaning to the property, because the property is the value and what collateralizes the actual loan. Meaning if you kill over and die, or you walk away from the property, or something happens, that bank still has to get its money back off of that collateralization of that property. So they're doing both. And so while you're a piece of it, the property is a piece of it. And so I want to talk about property. Occupancy type. Primary home means I am living here full time. This is my roof over my head. Okay. Secondary home, AKA vacation home, lake house, beach house, ranch house, ski house, fill in the blank house. It is a second home that you vacation to and you occupy some of the time, but not all of the time. But it's still considered an owner occupied, because your intention is to occupy it some of the time. Third one is an investment property, a full non-owner occupied property. I do not plan on living there at all. I'm going to rent it out for, long-term, forever. Sometimes it's a 12-month lease, sometimes a 6-month lease, but the component on the non-owner occupied is you have no plans of ever living there or sleeping there or having a life there as your own. Just your primary, maybe your secondary / vacation, but this one over here is non-owner occupied. And so the occupancy type, primary, secondary, and vacation, or non-owner occupied, they all matter. They're a risk to the bank. Why is it a risk to the bank? So historically, banks just look at data, right? They look at data every single year and they say, where are the most defaults and late payments and derogatories on mortgages? And so they'll look back and say, man, people with this credit score, people with this little money down, people with this occupancy over here, self-employed people, W-2 people, condo people, blah, 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 and they have this chart and say, like, these people perform the best, these people perform in the middle, these homeowners perform the lowest, and so we got to protect this. We're going to add more risk over here. So whenever there's more risk, the banks push back, and they either want more money down, more reserves, meaning more money in the bank, so in case you go hit a hardship, you're not going month to month, and so the risk of you walking away from that property or something happening is less, right? And so primary homes, from an occupancy standpoint, have the least amount of risk. If everybody goes belly up and something happens in a hardship in your life, you're gonna fight hard to pay that mortgage, because you want to keep that house for yourself, for your family, or your kids, so it's lower risk, and therefore they're not adding what's called risk-based adjustment to the rate, because obviously the primary is the least amount of risk. The vacation and second home is in the middle. Hey, if something happens, like, people will let their lake house go or their ski house go before their primary house, so there's more risk there. So they're going to add some extra down payment rules and some extra credit score rules and some extra interest rate adjustments because of the total risk, because they're loaning money on things that don't always perform, right? You'll be loaning again to your C friend, it'll pay you back in a month. It'll probably happen, but you'll be thinking about it at night when you're laying in bed. And then of course the non-owner occupied piece, sometimes tenants are just bad tenants, sometimes landlords don't know how to manage property, but the most defaults and risk are on those non-owner occupieds, and so obviously that's where the risk-based adjustment on that comes. Last thing, really, there's one more, but I'm not gonna talk about it small. Last thing is a property type, okay? So I just talked about occupancy type, primary, secondary, rental. Property type, okay? So the property types are single family, townhome, condominium. Now, again, this is all about risk. So if you're buying a house that is a single family detached versus a townhome or a single family attached or a duplex or something like that versus a condo, you don't get the same interest rate for the property type. Why? Same concept we talked about before. When they look at defaults in the United States, people that have a single family home that is detached from their neighbors, for whatever reason, you can figure it out, have the least amount of late payments and defaults on the properties. The ones that are attached are in the middle, and the condos are the worst. Now, use logic when you're thinking about the why, because the attached properties and the condos are attached to other people. So the single family detached, you are detached from your neighbor physically, and so what they do doesn't affect you and your property quite as much as if you were literally wall to wall with them and attached. And that's a big thing. And this is where banks know, hey, people that are attached to other people, unfortunately, sometimes what somebody does down the street or what somebody does next door, when you're attached, it affects you more than it would if you had your own detached place. So single family, attached in the middle, could be townhome, duplex, whatever, then condominium, so condos, okay? Condos are the highest risk when it comes to a property type. Why? So a condo, even if you, the buyer, are great, even if the unit, like this room I'm in, the condo unit that you're buying is great, you are part of a community. Think about it like a beehive, okay? So what happens is all the other bees in the beehive, all the other owners or tenants, everything that they do to the condo really ultimately affects everyone else, whether that be tenants, whether that be HOA delinquencies and payments, whether that be noise, whether that be paint, whether that be, litigation, slip and falls in the pools, all these things. So because what everybody else does affects your unit and your resale value and could cause you more drama, even if you're not actually causing the drama, can have an effect on your ability to resell the property in the future. And this is what mortgage companies know. So when people are out there shopping for home loans, I gave you a bunch of data. You have to understand, like, it's all about the market, the program, your situation, your credit score, how much you're putting down. Are you gonna occupy it? Are you not? Is it a townhome? Is it a condo? All these things, right? So I want you to keep that in mind on the how interest rates work and tied to all the people in the market all together. Second big part of this video is total cost analysis. This is the biggest one where I want to spend some time on it because I probably have this conversation 5 to 10 times a week with consumers that are misled or misinformed or uninformed or partially informed, with online lenders, mortgage companies, people that don't divulge or don't know the fullness of what an interest rate is in the terms. So there are two things when it comes to interest rates of what you qualify for, but what you're actually given. The first is the interest rate. So we're going to talk again in analogies like we have a quarter. We have a head and a tail, okay? The head will be the interest rate. The tail is the cost, aka the fees, aka the points. Now, they are both equal to each other, right? The rate affects the payments, and of course the fees affect your money out of pocket. But what happens most of the time is a lot of consumers only think about rate. They're like, I want a low rate. Why do you want a low rate? I want a low rate because I want a low payment. Okay, what you really want is a low payment. But the other component of that is the rate that a lot of people get quoted or see online comes with a lot of fees or points. And it's not the actual rate they qualify for. The lender or the bank is just pitching that rate. And then what happens is that rate comes with X, Y, Z in points or fees. It might be $1,000, it could be $10,000. And so here's what I want everybody to take away about this rate and fee component. There are three components to an interest rate that you, the consumer, almost always have access to, okay? Option one is what's called a par rate. It's like par in golf, okay? Not good, not bad, it's just what you actually qualify for. So your par rate is if you go into a bank, get pre-approved, they should give you a rate that you actually qualify for. Hey, hypothetically, you qualify for a 699. Now you have access to two different variations of that rate if you want to, and if the person obviously is honest with you and shows you the options on it. When these are available, you can get a premium rate. So a premium rate is you can take and elect to take a rate that's higher than the rate that you qualify for, but you will get like money back, but not cash money. It's like a credit back towards closing cost, all these things. And so if you're qualified for a 699, and let's say I say, hey, you can get a 7.5 rate and we'll give you $3,000 towards closing cost, or you can get a 799 rate and you get $6,000 towards closing costs. Sure, it might push the payment up $100 or whatever it does, but you as the consumer should be given the option. This is your real rate. Here is the premium rate in the scale. And if you take this higher rate, here's how much money you can get back. It should be a conversation and option with you and the loan officer, okay? Here's the part that normally happens with this rate and fee stuff. You qualify for this, and then there are rates that are a lot lower than this. Those rates are called discounted rates. Those rates that are discounted rates require what's called discount points, aka fees. So what happens is that your 699 rate, you may have access to 599. That 599 though might cost $10,000. So let's say there's 699 is your real rate, 599 is $10,000. So somebody might quote you a rate at 6.5. And you're like, that's a pretty good rate. Okay, great. What does it cost over here? It cost me $5,000. What you will find majority of the time is mortgage companies and lenders and online people know that consumers don't know what I'm telling you. So what are they gonna pitch you? They're gonna pitch you the fees? They're gonna pitch you the rate and the fees? Or they're gonna pitch you the rate? They're gonna pitch you the rate because they know that's all you look at. So they are not giving you the rate that you qualify for. They're giving you a rate that they know that will bait you in and that you'll like. And then what happens is you won't find out about the fees until later, until you get under contract or you get all this stuff. And then people just think like, I guess this is part of the deal. I don't know. No, it's not the truth. Any of those 3 rate options can be given to you based on what you want, but it's your hard-earned money and you should be told the truth up front of this is your rate, here are your money back options, here are your lower interest rate options, here's the money that it cost you, let me be honest and up front, and then you run what's called a break-even point and say, does it make sense to pay this money to do all that? But the takeaway on this is that all the time I'll see somebody, well, I'll quote them a 699 rate, they say, hey, I saw some person online, or I saw some quote, or some guy or girl over here told me that my rate was 6.5, why is it lower? And I tell them the exact same thing I'm telling you. You go to that individual or that institution and you ask them for a fees worksheet or a loan estimate. So you as the consumer can have the both head and the tail, because now you want to know what's the rate and what are the fees. All of a sudden, they bring me a fees worksheet and they have 6.5, and then what happens is there's $5,000 in cost over here. I'm like, your real rate's 699, 6.5 is $5,000. That only saves you $100 in the payment. Do you want to pay $5,000 to save $100? They're like, no. I'm like, did you ask that loan officer to do that? Or did they just hide it from you and then stick you with it at the end? They're like, they just put it on the paper and just send it to me. I'm like, how's that make you feel? It's a breach of trust. They're doing that for one reason and one reason only, to bait you in, because they're trying to get your business in a way that they know won't be as obvious to you, but it's obvious to people like me because I've been in the business forever. So this is why when you're getting rate quotes, you obviously want to know, and you want to get a total cost analysis. You want to get a fee worksheet. You want to get a loan estimate. You want to look at both sides of the coin. And so when you're getting pre-approved, all these things matter. And sometimes it is smart to pay points, and sometimes it is smart to get money back. It all depends upon the consumer, but it's a blank slate. It's a consultation. It's like walking to a doctor's office and they diagnose or prescribe you right there without having the full story. Like, it's not accurate. So what happens with lenders is they don't do all that stuff, but a lot of these internet lenders and people like this, they don't care about you. So they just quote this. And real in the fine print, it has what the fees are over here, but consumers don't read the fine print. They just look right here. So they think one bank's lower than the other one, but they're not. This bank's just charging you money where the other bank probably could too, but they're not trying to do that because obviously they're trying to either earn the business or be ethical or be respectful, whatever it is. I can't speak for everybody, but when you're getting an interest rate, now you know all the factors, but also you know kind of how things work from a rate and a fee standpoint. So it's really, really important, obviously, for everyone to make sure that they're getting the full picture, the full total cost, the rate, the fees, the details, everything in writing from the lender, so you make sure that you're being taken care of. The truth of the matter is they should send it to you anyhow, but they shouldn't just send you a sheet. If they're not having conversations with you about what's more important to you, payment, cash to close, a little bit of both, financial strategy, what do you want to do? Let's watch the market. Maybe we get some money back. You're going to refinance anyways. If they're just handing you a sheet of paper, it's like, that is almost indicative of how it's going to go. Like, they're not leaning into you and helping you, and these things are important. But a lot of times they'll intentionally send you something knowing the fees are there and the law allows them to do it, but you won't find out till later, and it becomes like a really bad feeling in your stomach, and then it just goes sideways. You're under contract and they never want your business and stuff here and there. And so it's also why realtors try to navigate and help consumers get to trusted mortgage advisors, because they know this stuff and they're like, hey, these people are really good. They don't pull any punches. These other people before, I want to make sure it's the best experience for you. So make sure it's not all about rate. It's about rate and fees. It's about trust the individual. But the last thing is price, margins, right? It happens. Some mortgage companies are more expensive than others. It's like anything in business. Price is only an issue when value isn't clear. Everybody wants to be competitive. By competitive, I mean every mortgage company should be about 1/4 to 3/8 to maybe 0.5% within each other. But there is competition in the marketplace, and there's margin in mortgage rates, and there's fees as well. Just like there's Walmart, and there's Tom Thumb, and there's HEB. Same concept. It's like Walmart's probably going to be a little bit cheaper. If cheap is what you want, go over here. And there's nothing wrong with Walmart. I love Walmart. I'm just saying, like, business models, peanut butter, Peter Pan versus Jif. Why is it 2 cans of peanut butter and one of them is $2.99, the other one's $3.49? Well, this one might be a little bit better, and it might add honey, and it might look prettier, and it might come off the assembly line quicker, and they might insure it better. And then so in order to do that, they have to have faster machines and a better CEO and, you know, all these things. And so they got to build in money to pay all the people. And so on the mortgage side, all that matters is trust and making sure they're going to close you smooth and on time and advise you the right way. But also, again, because so many mortgage loans don't close smooth and on time, like, to have a good mortgage team from start to finish, it requires people that are knowledgeable and skilled and and do an excellent job for the consumer. And those people that are highly skilled, that are not just push button get mortgage or online application takers, they require more money. That money is made in the margin on the rate and also made in the fees. And there's nothing wrong with profit. It's not a dirty word. It's just the wrong people make it a dirty word. But it's like going to a doctor. Your first thought is not cheap. Your first thought is quality. So what you want on a home loan is you want all of it. You don't want the cheapest price. You don't want the highest price, because if you get the cheapest price, something's falling way over here, right? So what you want to do in the mortgage business, you don't want to look for the cheapest. You don't want to look for the most expensive, right? If you get the cheapest interest rate, all these other things that matter, something's going to fall apart. If you get the most expensive interest rate and fees possible, the experience might be great, but it's going to cost you a little more out of pocket, and that might not be the best move. What you want is you want a good hybrid. You want a mortgage company, a mortgage advisor, and a mortgage team that has competitive rates, that are going to be good for you in the long run, but you've got a group of people and a team of people who are communicating with you, educating you, advising you, making sure that you are fully pre-approved, close, smooth, and on time to protect you. So that's why I think there's a good middle. Anything that's the cheapest is never the best. Anything that's the most expensive, sometimes it's the best, but we all can't get there, and we all don't need all that. And so the model is kind of a hybrid in the middle, so you can get the best of both worlds, price and value. So listen, I hope you found this video useful. I know there's a lot of information, but if you did, do me a favor, like, comment, subscribe, even share it with somebody that you know that could benefit from this information. If you want to have a conversation on interest rates, pre-approval, or anything about the home buying process, do us a favor. Call us, email us, text us. We're always here for you. Until next time, stay tuned.